seem to start these webinars when we're on the market lows. Wow. Wild, wild, wild. All right, well, we'll get started in about 2 minutes time, guys. I think you can hear me, you can see me. I should be able to see my screens. Is the market spicy enough for you? Sheesh. Well, it'd be interesting to I wonder what opinions are and whether we close positive or negative on the day on the S&P or the Dow or the Nasdaq, same kind of thing. And the Dow's outperforming slightly, but we've come off the highs massively. It's a headline driven market. I want to talk a little bit about the volatility before we go into the topic, but I'll start in a moment. Let's let everyone jump in. I can't ignore the volatility, right? Even though we've got a schedule of topic that we're going to cover. It's just a different. This is the wildest environment I've ever traded. I started in 2001. I've traded through global financial crisis, 9/11, COVID, flash crash. This is the most volatile environment we ever had electronically, I think. Some people might say the dot-com crash may be more volatile, but I just missed that. But this is super, super volatile. So we shall see where we close. It's a very headline-driven market. It's a very fickle market. We know what's driving it. We know it's all about tariffs. We know it's all about how China's responding. We know it's all about how Europe's responding to a lesser extent. The main man, obviously, is Donald Trump and people in charge over at the White House. So as we push into new lows, tick index is getting absolutely hammered. These are low, massively low ticks, real risk off at the moment for the last couple of hours. Let's see what happens. Okay, I think you can all hear me and see me. Give me a thumbs up if you can. It's much appreciated. I will look at the chat quickly, and then we will get started. I've got a few things to mention. Cheers, Robert. Cheers, Martins. Mohammed. Appreciate it. So I hope you're faring well in this volatility. And I want to mention a few things first. I've got some notes over on the side of my screen here. 10 things actually, or 9 things. So the first thing is, listen, this is super, super volatile environment. And you must, I know it's a cliche, but use a fixed stop. Why? Because if you plan on coming out at a level and you're intraday trading, headline risk is huge, bang, market suddenly rips off, you're there deer in headlights, it can get nasty very, very quickly. So real easy solution is just to use a fixed stop. And yes, you're going to get slippage. Yes, it's not going to be perfect, but it'll save your bacon if you're long and Donald Trump comes out and says something very, very bearish to the market. So we're going to be more aggressive with tariffs, or China comes out and says something more likely from that perspective. So please use a fixed stop. And I know many of you use mental stops, but I think that now's the time to go to a fixed stop. Okay, 2 and 3. FOMO is dialed up to the max right now, or it can be. You have a propensity to be operating from a condition of FOMO sometimes. Be aware that the volatility amplifies it. Okay, you see the market running on, you wish you were on board, you chase, get caught up in stuff. Yesterday was a perfect example. Had that headline come out, whoosh, off we went. If you're hesitating, it's not part of your strategy, you end up just saying, I wish I was on this rally, you buy. We had the other headline that came out and said it was all nonsense and reversed. Very, very nasty. So be careful if you have a propensity to trade with FOMO. Number 3, patience. The opportunities are plentiful. You are far better stalking and getting a 10-hour trade over a 3 or 4 5 day period than punting away, scrabbling away, maybe if you're lucky making a couple of hour, or at worst kind of really wiping out. So patience. The opportunities are there. If you like to trade it, that's fine. And by the way, there's no shame in standing aside. I know a lot of people, I just don't like this hero stuff of, you should be trading really aggressively. So listen, if this is your edge, then trade it, and you know it's your edge and you'll be trading it. If it's not, and it's just the volatility that's seducing you, live to fight another day. You don't get double points or double money for going to your bank manager and saying, hey, I made this money during this volatile period. So if it's your edge, fine, press it. You'll know it's your edge because you know you do well in these environments. If it's not, you can't get a grip on things, then step aside. Then it's absolutely no problem doing that, or somewhere in the middle. You trade you, not what you think you should trade. Okay, a couple more things. Listen, confidence. You want to look back and say that, hey, at the very, very least, you want to look back and say, I didn't do damage, right? That's the number one thing. Risk management, top trader set, Paul Tudor Jones says it, risk, right? We don't want to look back and feel regretful that we screwed up during this time. Now, perfect world, you make a bit of profit, great, or you make a lot of profit, perfect. But at the very, very least, the absolute bottom line should be I didn't do any serious damage. There'll be traders I know who will have lost big, right? You don't want to be one of those. If you are already in the hole, just say to yourself, you know what, I've learned a lesson here. I don't need to dig myself a bigger hole. Okay, a few more things. Trade small, of course, tame the volume with size. Taking breaks, I think, is you don't realize how much focus and energy you're putting into trading if you are intraday trading this stuff. Be careful of the percentage moves, right? They look ridiculous on paper. This morning we're up like 4% or whatever it was, but on the chart, when you calibrate it to the range and the ADR we get on the chart, use that as your reference point rather than the percentage moves. And finally, watch out for bad habits. Now, I say this because if we stay in this environment for a long period of time, you have to adjust, you have to recalibrate, change the way that you operate, and that doesn't lend itself to good trading when we come out of this and back into a normal volatility environment. So just be careful if you have any adjustments to your operations, your executions, the way you approach the trading now, and you're doing it to accommodate the volatility, just be mindful that they don't always work in the kind of normal environment. Just be mindful of that. And just be smart, guys. This volatility is great. We thrive on volatility, but if it's just a point where you can't get a grip of what's going on, you can't find edge, then it's gambling, and you don't want to be going into the casino. You want to be picking your spots and being very, very careful. There are spots, there are opportunities, I think, for most traders, but if you're fearful of it and you're doing it just because you think you can win big quickly, then be very, very careful. Be very, very careful. Okay, so that all being said, I hope you are navigating this storm with success. And also, listen, the headline risk is huge. I don't think I've just talked to traders before I came on this call. I don't think I've traded in an environment where we've had this headline risk. I say I started 01, so we used to have all this stuff when we had the Greek financial crisis and headline risk was there with Merkel coming out and this and that and the other. And we've had periods where, but at the moment it's so binary. It's like one tweet, one comment, and it's up 3%, down 3%. And that can't be managed. You can be managed. You can obviously use a stop, but you can't manage when that comes out. It's not scheduled, and so there's a lot of random sprinkling into this whatever setup you're taking. Except there is that way larger than normal headline risk. We've always got headline risk in trading, but now it's ramped up to 10, and you just don't know the moment you take a trade. Hey, am I going to get some headline risk in my favor or against me? As long as you accept that and you manage it as best you can with a fixed stop, smaller size, that sort of stuff, then fine. You understand the name of the game. You understand the risks and the game you're involved in. But just being appreciative of that and saying, hey, I'm actively deciding to risk capital, even though I'm aware of headline risk. I've mitigated it as much as I can. I'm still accepting it. Let's go. Okay, so let's get down to the topic du jour. I'm going to be glancing over here just to see if anything crazy is going on. Maybe we'll put that up in a moment. So Trader 2.0, we're in this April series. I wish I'd have known it would have been so wild like this, but this is going to be very, very apt actually for the current conditions as well. Time-based trading tactics. And we want to really go in deep into how timing plays such an important role. And for me, it was a real epiphany, if you like, when I realized actually a chart setup looks great, but if you put exactly the same setup or a technical setup, or however you want to frame it, in a different time period or different time of day or a different day of the week, it can be very, very different in the outcome. We'll go through all that in a moment. Linda Raschke, great quote from her. Good timing comes from a feel for the rhythm of the market. You can't teach it. You develop it by watching price action for thousands of hours. That's true, but we'll dig into it more in a moment and give you some ideas, hopefully, to improve your trading aspect. Oh, help us if I'm clicking the right button here. Right. I must, before we continue, remind you, ladies and gentlemen, that trading is a risky business, super risky at the moment, right? You've got to be careful. Leverage right up. News comes out, you're going to get a real horrible haircut quickly. So, yeah, please just understand, recognize what you're doing, how you're trading, how leverage works. If you're new to trading, this is not the place to cut your teeth. Go on a demo. Keep your capital safe, live to fight another day. And if you are a seasoned trader, just remember, hey, this is how it works, right? You can make money very, very quickly. You can also lose it very, very quickly. Risky business. There will be fortunes made and fortunes lost in this market. You want to be on the right side of things. You might not be able to make a fortune. You might not be in a position to, but hey, just surviving and just putting some numbers on the board is good at managing risk and being aware of stuff. Okay, so objective for today, ladies and gentlemen, as we push to new lows. The objective for today, I want to help you unlock how time of day can help improve your trading, right? I'm going to do this by how we look at algo moves that are firing at the top of the hour, bottom of the hour, looking for those. That's one topic that I wanted to include. It's kind of a little bit of a rogue topic, but I wanted to include it. Adjusting your trade targets based on which session we're in. So how do we calibrate the conditions, or how do we calibrate our trade entries, exits, targets, stops, depending on time of day, all that other type of stuff. Using time as a filter to keep us out of these naff trades, and adding time-based variables to kind of help adjust the strategy. It will become clear in a moment. As always, well, not as always, as we're doing with this April Trader 2.0 series, like it's more intermediate advanced stuff. So I'm kind of making the assumption you've got some trading experience, you've traded for a while, you've got a reasonable strategy you like to approach, you've got an instrument you like to trade, you have some kind of focus. It might not be perfect for you, maybe things aren't quite there yet, but this is kind of hopefully going to, a little light bulb goes off and you can go away and you can do some digging for yourself. Quick reminder, guys, I won't spend ages doing this. As I say, I've got a lot of decent experience in the markets, but I don't pretend to have all the answers. I'll share with you what I think is helpful for your trading. I happen to observe other traders as well coming up the ranks, people who fall by the wayside, people who do extremely well, and so I can share some of the insights that I see from different personality types and different character traits and what's working for them, a kind of that vein of gold, if you like. Take that out and share that with you as well. Always do your own research, right? Whoever you listen to, wherever you're listening to your information from, and recognize things take time. If you're going to, at the end of this webinar, say, hey, you know what, I want to implement time somehow into my trading as a filtering process, as a trigger, as a dynamic adjustment for my targets, as a trade entry trigger, then fine, you make your own decision, but recognize that take some time before you audit the results. Okay, so let's go straight on to stuff. Every market has a rhythm. The markets move in waves, and our job, and this is across everything, right? Not only just price going up and down, which we all know, the rotations of price moves higher, price backfills, price congests, price consolidates, price expands into new territory, volume expands, volatility expands and contracts, right? We have this volatility expansion contraction phase, okay, and that goes hand in hand with liquidity. It goes hand in hand with who's awake. In other words, you know, if the Americans are awake and we're trading, if the futures are trading and they're linked to the cash or they're linked to the stocks, we're going to have more volume. And most people know this already, but we also have this intraday as well. We have the open, which we know is generally more volatile, and the kind of contraction of volatility. Last couple of days, slightly the exception to the norm, but even now we have this, you know, rotation of volatility towards the end of the day, expansion of volatility. Same for trading currency pairs. If the currency pair you're trading, other traders who are actively trading that pair awake? Is it linked to maybe money flowing around from other asset classes like equities, like gold, etc.? So just recognizing and understanding the rhythm, you know, and we want to trade with the flow. You know, our objective as traders is not just to be, listen, if we're honest, right, reading charts and being a technician is quite easy. Yeah, it's quite easy, isn't it? You get a chart up, you draw a line, you draw a trend line, you put it on, you say there's support, there's resistance, there's a trend line, and that's fine. That's not enough. And you know it's not enough because you've probably tried it out and gone, oh, you know what, it's okay. There has to be more to it. There has to have a little bit more flavor. It has to know when the participants are active, when people are more urgently trying to fill orders than others, understand, you know, how the markets tend to move in a certain rhythm and structure. And your job as a trader is to be very in tune with the market that you like to trade. So if you trade cable, understanding the rhythms and nuances in the Asian session, European session, US session, the overlap. What happens when the equities are open? What happens when the equities close? If you trade the US indices, understanding, hey, well, actually, the final hour when we're already under pressure, maybe we're going to have this type of flavor. And so you then approach the market from, okay, I understand who the other participants are. I have a rough idea what their objectives are. I understand the time constraints they have, and so I'm going to trade accordingly. We'll explain all in a moment, but hopefully we're starting to lay the foundations a little bit for you here. And the problem we have is if we ignore time, is that very often you can have an absolute great setup, but if you've got it at the wrong time, it's just not going to give you what you want because there's no participants there. A really rough example might be, okay, I'm trying to trade, it's really example, but imagine you're trying to trade a breakout. It's an inside day already. You've got FOMC coming up. Forget about the current conditions now, the tariffs and stuff. But imagine you have FOMC coming up. That's all everyone's looking at. Inside day, inside in the week, not much going on, already done maybe 75% of the ADR on the day. You're buying a breakout at midday, man, it's just doomed to failure. You might get one or two, but over time that probably has a negative expectancy because the time of day you're doing it and the time of week you're doing it, all that kind of stuff is not stacking up. Versus, let's say you've already had a market that's pushed the highs, trapped a load of people, and now on a Friday afternoon you're selling into fresh lows. Same theme, selling a breakout. Okay, I could probably give you different analogy there that was exactly the same, but the point is you're trading a breakout, but the conditions are very, very different. Time of day, more urgency, position, more urgency, and it could be exactly the same chart setup, but if it's the wrong time, it loses its edge. It loses its edge completely. And you probably know this yourself, right? How many times have you taken a trade and you've gone, yeah, but technically it looks so great. And actually, when you've analyzed it and looked through your journal, you've said, what was I thinking, man? It's like we hadn't even broken out the Friday's high there. We're still in this multi-week range. We're waiting for what am I playing at, man? I'm trying to trade momentum ignition when no one really is there to cause the momentum in the first place. I should be sticking with mean reversion. Same with mean reversion, right? You can flip on its head and say, right, I'm going to be fading this level because it's a key level. Well, great. But if there's a massive urgency of a reprice scenario, then all levels are out the door. Okay, so multiple time factors: time of day, the flow of the session, rhythm of the session, and then how close we are to some key event. Generally speaking, if we've got something that everyone is looking at, Fed, CPI, all the other stuff like that. We had obviously the tariff thing a couple of days ago. What did he call it now? What's the day he called it? Freedom Day? No, what's the day? It was a couple of days ago, man. My mind is trashed by the volatility. Liberation Day. There we go. Liberation Day. Everyone was expecting that. So up until that point, everyone was on pause, right? Because you think about if you're a hedge fund, you're allocating risk capital. Are you going to punt away before you have all the data? No, you're not. You're going to say to investors, hey, we saw this and then we took a position and this is why. And even if that is down, as long as you can justify why you've taken that position, that's your job done. Don't forget they've got a very different remit to us as retail traders, guys. Not always. But if they said, oh, well, I took a little guess and I thought CPI was going to come in hot and we're down, that's very difficult to justify to investors versus we did this, we did the analysis, all these genius PhDs went out and did this number crunching and we thought we'd go long. We're just in a bit of a drawdown at the moment. Very, very different. Right. So just consider that that's important when we have event proximity coming up. And I believe that time is one of the biggest overlooked advantages for a retail trader. Unlike institutions that have to work orders over time, over in volume slice, TWAP slice, time slice, volume slice, they get orders late in the day. And I'll give you a chart example in a moment, but they've got a very, very different approach to trading than we have. And that's great because sometimes we can spot when they're active and they don't necessarily care about a short movement intraday, but that's our bread and butter. If we can ride their coattails for a little bit because there's an algo active or because generally the volatility is increasing or volume's increasing or VWAP algo's got more aggressive, then I think that's edge. So timing is a filter. This is a good way to start this whole thing. If you start to think of time of day as a really a primary filter before you even consider the setup, because I guess you're watching this, you understand technical analysis, you understand breakouts, you understand wedges, pennants, flags, double tops, double bottoms, all the other good stuff. And that's perfectly fine. But how about if you add a primary filter of time? Because when these setups occur matters just as much as what and how it's affecting it, right? So timing is just as equal as the trade setup. And in fact, I would argue more so. The timing is so much more important because if you're in the right time when there is money flowing in, there's bids being lifted, you can be a little bit, dare I say, sloppy with your entry, and it still works out for you. Go more depth in a moment, make some more sense in a moment, hopefully. So it also helps us filter out low quality setups, right? We might say, I don't want to take any breakout trades at lunchtime. I don't want to get involved in any range expansion, volatility expansion type trades when we have event proximity very, very close. I don't want to trade mean reversion after we've had a reprice or after we've had a Wyckoff type spring, whatever it might be. And I think that, maybe it's a little bit of a broad, bold statement, this, but a lot of losses come from the timing of the trade. And also, this is not just from the timing segment, and we're covering that as well, but also, how we're deciding to take profits. Are we in an A to B environment where we want to take quick profits, or are we in an environment that is likely to maybe range expand, is likely to, well, I've got fireworks here. I see my fireworks coming out. It's weird. So I'm watching this and seeing fireworks. Must be some shortcut I've got in my hands. Range expansion, got to be careful how animated I am. Range expansion, like you think you're coming into a time when you have got a range expansion. So you're like, okay, well, I will hold it for the breakout versus, hey, this time, this segment doesn't necessarily lend itself to range expansion, volatility expansion, testing of new prices, auctioning higher prices or lower prices, depending on where you're positioned. I'll just take an A to B trade. So it doesn't just affect how you take the trade and whether the validity of the trade, it affects how you manage the trade. Am I looking for A to B? Am I looking for extended moves? And then having some rules and segments of time where you go, hey, I can run it during this period, or I should look for extended targets. I should hold a little bit longer. Just adding the extra variable in rather than just being so focused on price, which I know that so many kind of traders are. It's just price, just price, just price. And I get it. And I think that's better than adding in loads of indicators. But I think that time is a really super useful variable to have. So before we kind of look at a chart, just think about this. And this is kind of really on a basic perspective. We'll dig in more. But you think about the volume volatility cycles. If we're talking about the equity market, whether we're trading the DAX, whether we're trading the Dow, whether we're trading Nikkei, whether we're trading any of those equity markets, they've all got an open. And we know and we all see they have a high volume at the market open. Why is that? Because the market open orders, it's the first time you can trade a lot of the stocks. The options are open. There's a lot of things that kick into gear. Yes, I know there's pre-market on a lot of the instruments and a lot of the thicker stocks. I understand that. I know we've got the futures, but it's when the whole system turns on, options are open, more volume is there. It's really like ding, 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 everyone starts. And so we get that high volume is why the opening range breakout trade is at the open, because you're expecting that volatility to expand and continue and trying to get onto a trend day. So pretty simple stuff, but we know this. Then often we get a midday lull, right? At the moment, perhaps not so, but generally speaking, lunch hours, mean reversion doesn't really do much, depending on the day type, of course. But we have that crush in volatility, crush in volume, and then end of the day, we either have a kind of increased volume, or we kind of pull back to the VWAP, or we kind of continue on the trend. I know I'm being kind of simplifying it a little bit because it very much depends on the day type, very much depends on the position of price. But generally speaking, it's that smile of volume. So big volume at the open, dies off during the day, and then rises a little bit towards the close. And so, when we think like this, think about these session-based patterns, right? We were trading the open at 230 UK is the US Open. We have this surge of liquidity, we have the momentum. And one thing I would say is this can work for you and against you. Because I think that the open can be a very lucrative time to trade, but it often can be a trap as well. And so it's a double-edged sword. As very often is the case with trading, a lot of trading, we have this issue where, yes, we want the volume, we want the range expansion, we want the range, decent ranges, but at the same time, we don't want it so wicked that it's pinging us out. And so your first 5 minutes can be a little bit crazy, and then it kind of get that sweet spot, maybe 5 minutes past 35, 14:35, should I say, up to kind of 3:15, where you get like a decent volume, and then it kind of chugs into normal conditions. Lunch hours, be careful of getting caught in traps. And also, it's a perfect storm a little bit in lunch, because you may be looking for more profits. Let's say you've made some money at the open, and you say, oh, I just want to make some more money now. you get trapped taking lunchtime trades. Perhaps you're trying to recover some of the early losses, and so you kind of force those lunchtime trades. Be very, very careful. In normal conditions, tends to be a trap, which is why many traders won't trade the lunchtime hours. In the final hour, you have the continuation of the trend, or you have the reversal, or something happens. I'll explain kind of why I believe that is in a moment. So knowing when your strategies do the best is important. So if you've got buckets of strategies now, a mean reversion play here, a pullback play here, a range breakout here. If you haven't already, just categorize those into time so you know when it's best. Here's a great example, actually. No, not yesterday. Friday, this was. You then traded Friday, and it was a really heavy down day. And we had this pattern quite a lot, and it's a really good example. Why there? What did we have that aggressive selling? Why at that point? You might be like, oh yeah, because we pulled back to this level and blah blah. I guess it was a key level, absolutely. But at that point in time, just think about the opponents we're trading with. Okay, mega down day, very very heavy risk off sentiment, and now you've got 45 minutes or something like that, 20 minutes, sorry, I think it was about 8:45, so about 20 minutes, 15 minutes before the closing bell, before the weekend. Think about the whole scenario here. Headline risk is massive over the weekend, already down heavy, the markets are. People are already under pressure if they've got a risk on sentiment or they're overweight US equity. Talking about hedge funds here or bigger institutions. They got 15 minutes to dump stocks, right? If you want to get out, you got to get out now in 15 minutes. And at that point, and that kind of rally back up, everyone's hoping, okay, well, maybe it kind of pushes back up a little bit. I can peel some off. If all of a sudden sentiment shifts and we go, we need to get out fast, the time plays a big issue because they know that once that bell goes, there's no liquidity to get out. They can't do anything then. It's scraps after hours. And we haven't got much time anyway because it's a Friday. So the pressure is massive. There's a time of the bell, there's a time of the weekend, there's a headline risk. This has nothing to do with a chart pattern here. Yes, when you mold it together, you've got actually potential trigger of getting in when you see that key level that was holding, classical support turns resistance. But I don't want you to think about that for now. I want you to think about the participants and why we got that sell off in the last 20 minutes, because everyone's running through a very small door. It's a perfect example, even if it's not your thing and you don't like to trade this stuff, it's a perfect example of how time is adding a constraint that can work in your favor. You just know, and it's about this playing chess. And I kind of always like to think of trading like this, and I think I've shared this before in other webinars. Of okay, why is someone going to sell after you've gone short? Because that's how you make money. Why is someone going to buy after you've gone long? Now, if it's because you think it's an inverse head and shoulders, well, that's fine, and that might be a timing mechanism, but you need more than that. You need more of a reason and justification. If that's because actually we're quite extended and we've had some sort of good news and now then fine, you're adding some layers to the trade. So this example here that we had on Friday was time was absolutely, without any question in my mind, the reason we started to sell off there. Otherwise, we could have just drifted up. If this had been 2 hours earlier, we might have drifted right back to the VWAP, stayed there for a bit, and then maybe casually rolled over. But because there was a sense of urgency, and because we had the time of the Friday, with the time of the bell coming up, people needed to do business. They were already under the cosh. We already realized what side was the more aggressive, the sell side. And so you got this. So this is even though this is a very cherry-picked example, it's a recent example, which is why it's so perfect. But hopefully it helps you think about time playing a really key part in trading. I'll give you some more examples in a moment. So let's put that to one side for a moment, timing our trades based on when we expect volatility expansion, when we expect volatility contraction, when we expect range expansion, range contraction, same type of things really, when we feel like people are under pressure to execute or to get a lot of business done, when we feel like everyone is looking, trading works well when everyone's looking at the same thing. Like if everyone's looking at, that's why prior highs and prior lows are so good and opens and closes are so good, because everyone's looking at that number. You can't make that number up. Trend line you can make up a little bit. Support level you can make up a little bit, less so. But when we have a finite time, a finite price, everyone is looking at that. So everyone is making a decision based on that. And so when we can add those into our trade, we can start to maybe work out what the other participants are thinking and position ourselves to take advantage of their bad luck in this case, or urgency. They don't care. They have to get out. They've got an order to sell the rest of their portfolio, or peel off 5% of the portfolio, whatever. By the end of the day, we don't want to be holding more than X% risk over the weekend. Get it done. Bang, bang, bang. Smashing bids, smashing bids, smashing bids. That's when we get in that type of environment. Okay. So, and by the way, it's not just this current price action we're having now that's causing that. We have this quite often. If we've had a really kind of heavy bid during the week and we roll over at Friday, we have the last hour. You can reverse engineer the urgency for yourself. Okay, so let's talk about holding time. So how do we marry up time of day stuff with holding the actual trade? Some trades A to B. Take your profits, run. You don't want to be a hero. You're not trying to be clever. You just think, hey, we're going to pop off here. I'm going to take it and run out. Example at the moment, this down move now, it's pretty heavy, but there are people there who are probably scalping out this little exhaustion. They're not looking for full scale reversal. They're like, hey, I get an exhaustion pop, I'm done. That's not a trade to hold. That's a counter trend trade that is just going to work for a few minutes, a few hours, depending on what time frame you're on, one and done. Okay, and it depends on the time of day for this as well. We're on that in a moment. Ideal window. So, if you are holding a trade, let's say at the open, and you've done this, as we've all done this, right? You've held a nice trade at the open, you've got a good solid bid, you're long, it starts to kind of peter out at the top, you've got a target a little bit higher, goes on and on, it just starts dragging. It just starts sitting there, drifting lower, pulling back. It starts going to this random price action, this choppy price action. And that's really because you've probably held it more than you should. Now, if you've got an all-day hold logged in, multi-day hold, you're fine, and that's okay. I'm not saying adjust your strategy just because of that. But if your strategy is designed to ride momentum and you're then going into the lunchtime chop, then you're not aligning your strategy with the time of day. If lunchtime has a propensity to be choppy, you've looked at the prior market conditions last 4 or 5 days, 6 days, 6 weeks, and you realize actually things start chopping around at lunch, your momentum trade, then holding it during that chop isn't part of the trade thesis. So being aware of that and saying, hang on a second, it works both ways, by the way. If you're trading mean reversion at lunchtime, you're kind of fading these little flushes high and low, and then we start going into the closing hour or so, you're trying to align a trade type with the wrong market conditions. So something to think about is like your holding time. I don't want to go too much into trade, how we hold trades longer and this type of stuff, but just recognizing chunking the day up into these segments and saying, okay, am I bleeding one trade into another segment? Am I trying to trade momentum in a mean reversion segment? Am I trying to trade mean reversion in a momentum ignition type segment? And just recognizing, hey, how does the market perform during these times? What are the rotations of the market we're seeing? Example, in the open, you might get these nice clean rotations. Go into lunch, you get tighter rotations. If you're there looking for the rotations that were happening at the open at lunchtime, you're not going to get them because you're asking the market to change conditions just for you. And this is why I think a lot of traders have the disconnect between, right, well, this is my price of entry, this is my stop, this is my target, and I'm only going to hold for this. But actually the market's not in that rhythm. It's not in that structure. The rotations aren't doing that. The time of day is not correct. And you're asking it to behave in a manner it's not. Now, sure, could things change and it suddenly goes crazy and you kind of get that price spike? Absolutely. It's not. Nothing's a dead cert. But our job as traders is to try to blend in with the flow we've got, whether it's extreme volatility like we've got now, or it's like a calmer rotation market, testing this level, coming back. You know the difference. And that's our job as a discretionary trader, is to feel the conditions and get in tune with the conditions. And part of that is to calibrate based on the rotations, the time of day, what price has done, higher time frame, all this type of stuff all comes into the decision-making process. Okay, so I've covered this, so I won't spend too long on this, but listen, by now, hopefully you're thinking, right, I understand that these are different segments. We don't want to be taking breakouts during low volatility. Pre-data, lunchtime chop. Be cautious with mean reversion late in the day. There's a caveat to that. I do have a VWAP magnet type trade, which is, hey, when we have been rotational and we start to roll back over, I might trade a mean reversion, but that's only because I'm aligning with the conditions. Generally speaking, if you've had a range expansion, fresh auction process and advertising of higher price has been accepted over lunchtime, then asking for a full-scale reversal is probably a lot. Does it happen? Of course it does. But playing that mean reversion there is just asking for something the market is probably not going to give you. And like I said earlier, thinking several moves ahead, like, okay, if I go into this, let me not be so myopic on price. Let me think about, how could the last hour look? Could there be a sense of urgency in the last hour? Why could there be a sense of urgency? And which direction would that be? And which direction would cause the biggest move if we did it? Going back to that chart, absolutely it was going to be to the downside because everyone was underwater and wanted to get out very, very quickly. And yes, this was a very high volatile environment, a very unique environment, but we have this recurring theme a lot, just on a smaller scale. So, and as I said, is it the last day of the week and sitting at lows? If it is, you might be everyone's rushing through a very small door. Okay, so let's talk about kind of timing this stuff. So candles can act as like a trigger, right? You've got these wide range bars, reversal bars, engulfing bars. That's your signal, okay? And the most important thing is the context. So the time of day and the price structure. So price structure, not bar structure. In other words, you might see a bullish engulfing, you might see an ignition candle, but if you see a random ignition candle in the middle of the trading day, who cares? Nobody cares. If you see an ignition candle to the upside after you super stretch, jump through the prior day's low, big exhaustion, then you see the ignition candle, well, maybe that supply demand just taken a massive shift in one way, and that might be a trigger for you. So the bars are good and candle patterns are good, but in the right context. And I want to stress this, the context is so important. The bars help you with the trigger. You see the reversals, you see all these little patterns, bullish engulfing, bearish engulfing, outside bar, inside bar, doji, then this and that, the other, shooting star, all this type of stuff, right? You can swallow a candle book textbook if you like, but the context is where the true traders can really start to navigate things much better, and then using those as a final kind of trigger. So let's talk about some of these traps. Very often we get these traps pre-news. We have a kind of move in one direction, sucks a lot of traders in, reverses back. Most of the time, price wants to stay near a mean. That's a VWAP, a moving average, whatever it is before news. Why? Because why would a buy and sell side want to take, going back to that earlier point, why would they want to take unknown risk? You might be like, yeah, but you think about from their perspective, how are they going to justify that to their investors? Because people obviously trading bigger money. What's my alert going off? My alert's going off because we've had a big spike to the upside. This pinging off lows at the moment. I've calibrated it to a 100-point move on the Dow in 1 minute, and yesterday it was like ding, 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 ding. I was like, okay, I may need to recalibrate that. But yeah, you think about hedge funds and money managers. The reason they've got all these assets is because they have investors, and so they've still got to justify their decision-making process and why they moved the way they did to the investors. And so think about this. And you might be like, Mark, I don't care. Do you want to trade intraday? Yeah, I get you. But if you can get into the minds of people who are trading in this way, then you can then try to understand and preempt their moves, right? So if you think no one's going to really truly commit capital, so we're probably not going to explore fresh price before news, then would you want to buy breakout? Probably not. Now, does it always work? Absolutely not. But the propensity for price to be at a mean before news is quite high. Low volume periods easy to manipulate price. We see this often with overnight markets. You see them running up strong, which is why I put less of a weight on the overnight session these days as I used to maybe 10 years ago, 15 years ago. Purely because I do feel there's a lot of kind of manipulation overnight. You can bid a market up, and one or two strong buyers who are just trying to get out of the market or get into the market can make a very, very big move in price, which is why often you see prices gapping up overnight, Dow, NASDAQ, whatever it might be, and then you see that flush straight away, which is generally like, okay, the real move is there, and that can offer a trading opportunity from there. So 4:30 p.m. is a European close. 6 p.m. we often get a spike in one direction. So many years ago, I want to say 2008, something like that. Maybe not even that. 2005 probably. I went to this proprietary trading firm in Las Vegas. Bit of an excuse for a trip to Vegas anyway. So I visited this guy, and I sat on his trading floor, and he was kind of sharing. Sun's blaring me. I hope I've shielded enough here. I'll move back a bit. He was sharing some of the things that he did with his traders, and one of the things he did was called noon balloon. So this was when price would very often have that last flush into that midday period, and then it would kind of roll back over. And so, this has evolved over time. If you look at your intraday chart on the US indices, very often, not always, none of this stuff works all the time, but very often you see this kind of press into sort of 6 o'clock, 5 o'clock, 6 o'clock, and then it shuts off. And that supply demand imbalance suddenly goes back into balance, and we roll back over. So if you're long, you're kind of holding for that last price spike. 4:30, obviously the European close, very often moves will push into 4:30 and then reverse. And so being careful, and maybe don't use it as a trade trigger. I'm not saying go short when you see a price spike at 6 o'clock or initiate a trade, but being aware that, hey, if I'm taking a traditional trading setup, a traditional kind of chart pattern, and I've got these time of days, and you might have something for your asset that you trade, right? If you're trading USD JPY, if you're trading different time periods, you might know some of these things yourself. And so being aware of them and recognizing that, hey, I'm thinking about the other participants. That's when money flow starts coming in. That's when maybe bell goes for the Europeans. There might be a shift because actually it might have been a lot of European money that was pushing and now it's stopped. They don't know why, but there's often these reasons. So understanding when the traps are for you. Okay, so how could you kind of implement this from an operations perspective? Adding timing to your entry filters. So one thing you can do is say, hey, I'm only going to trade breakouts during these windows of time, right? Or I'm only going to trade mean reversion during these period of time. Or I'm going to combine this period of time with a trade setup to get my edge. In other words, I'm only going to trade bull flags during the opening 2 hours or the closing hour if we're at fresh lows, bear flags. That type of thing that helps you then become a little bit more systematic with your broad rules to keep you out of trouble, but at the same time allowing the discretionary part of a trader to you, discretionary element of trading to come in. I don't know if any of you listen to my podcast, the Traders Mastermind podcast. I recently, actually it's quite a while ago now, several months ago, I interviewed a trader called Rushir. Rushir, maybe you're listening, pal. I know you're doing well, and I hope you're navigating these waters well as well. The title of the podcast is From Part-Time to Full-Time, I think. But the point is with Rushir is he had a really good year last year, and he's touch wood, he's having a great couple of months at the start of the year. But what he does very, very well is he restricts his time window when he will trade his setup. So he's got the whole day to trade. Now he's a kind of free agent, but he's still very, very strict and says, I will only take my trade between this because when I reverse engineer what I'm looking for the trade, that's when it's likely to happen. And part of that's experience, part of that's just knowing the time of day when these things occur. So maybe a task for you is to say, right, what's my favorite type of trades? Well, I like trading mean reversion. I like trading these spike reversals. Okay, well, when does that happen? Do you want to trade that in the last 15 minutes of the trading day? Probably not. Okay, that's a starting point. When is it most likely to happen? Well, actually, you know what, if we get a counter trend spike during that lunchtime, 3 hours, I like that. Okay, then you start to build a very simple time filter into your trading. And you can add this to your checklist as well, or part of your process. So think about this, think about a time window strategy. So when there's a hot zone and a dead zone, and adding more color to this concept of how can you integrate this into your operations. You've probably got your setups, you've got your patterns you like to see, you've got this stuff. Adding an extra layer of time or being a little bit more constraint on time can really significantly change the edge. And actually, I've seen it turn around strategies just 180. Strategies that were super, super ineffective when you trade them all day long or all week long or all the times that you get them, versus being very constricted with when you take it can turn a losing strategy into a profitable strategy. No promises, no any of the other stuff like there's a holy grail or silver bullet nonsense, but It can do, because you are aligning the right strategy with the propensity of the market to range expand, volatility crush, range crush, contraction, all that type of stuff. So define periods where your strategy performs best, or that specific strategy, and then you can potentially get a higher win rate, better risk reward, cleaner moves. We all like a cleaner move, right? Want the price to go straight away in our favor, no chopping around. How many times you take a trade, click, and you sit there and it's oscillating up and down, you stop. It's your stop. Well, your stop's here, your entry. I mean, don't. You're like, do something. Probably because it's a mismatch of what you're trying to trade, the thesis of the trade versus the time window you're taking it. And just avoiding times when you've got lower probabilities, choppy price action, don't get the follow through, the false signals, and just be a little bit mindful as well. If you might be like, I like trade mean reversion, there's a difference between a range bound market I think that's readable and you can trade the reversals versus just complete chop. Complete chop to me is random. I look at sometimes chop and go, I have no idea what the next price is, and I don't believe anybody does, because 1 minute's up, 1 minute's down, there's no volume there, there's nothing to read. Our job as traders is we spot the shifts in volume, the shifts in supply demand. You've got that seesaw of around this massive buying coming in, there's a bit of selling, it's holding, buyers are more aggressive, here we go, sellers have backed off, wow, we've got that exhaustion move to the high side, pauses, all of a sudden sellers stepping in, and we can see that when we have that volume and we have that price kind of shifting in decent flow, we've got pace of the tape is high. When it's chopping around, it doesn't take much for it to move. And there's people kind of hindsight going, oh well, it broke out this level, yeah, but it could have done the high side or low side. Just be mindful, hey, to kind of really feel like I've got an edge predicting this, or am I just kind of guessing and hoping that it's going to work? Something a sort of a brief comment on news. We want to obviously take into account news events, recognize, I don't want to repeat myself about people positioning, but you kind of get that, adjust the risk if you are holding through news. And something I've noticed a couple of days, last week or so, disregarded, but something I've noticed with that CPI, PPI, all this type of stuff is, and with earnings as well, very often you might get a kind of push up into the news, then backs off a little bit, and then the resumption when the news is in line or it's not completely bearish. And so I call it resumption of trend, bad English, but that type of thing. And so as a trader, this would be you saying, okay, playing chess, thinking, well, that's probably people peeling back risk because they don't want to hold over the announcement or the economic data point and then putting it back on again. And so there's little patterns as well that again come in with the time of day when you're expecting the news, time of day when you're expecting weekend risk, headline risk, and kind of just trying to extrapolate and thinking and putting yourself in the shoes of the higher time frame traders. No one knows for sure. I can't sit here and say I definitely know what they're thinking, but if you know their objectives, which we do, if you know roughly what they're trying to achieve, which we do, which is generate alpha. Well, sometimes they're doing some hedging, sometimes this, which is why sometimes we see these moves which just make no sense. But if you can really get into the mind of the higher time frame money, then that is going to be an edge for a long period of time. It's an edge for life. And sometimes it's easier to read them, like the other day when we saw that panic selling in the last 20 minutes, because you know what's happening. You're like, okay, I've got a final target for this. I recognize why everyone's running to the same small door. There's my trade opportunity. And sometimes it's not. That's trading and appreciating it's not black and white. But very often the game we play is one of chess when you know your opponent is going to move that piece into that position. Okay, so morning trading, quick moves, strong breakouts, afternoon trading, grindy setups, generally speaking. Okay, I wanted to touch on this because this is really important, and I really like this concept. Something I've taken on board the last, say 5 years or so, maybe even more than that, whatever. Is this time stop and price stop? Not only that, but targets. So a time stop concept, and this is us now calibrating to the different rhythms and segments of the market and the volatility expansions and contractions and different money flows, and very often traders go, here's my price stop, that's it. If it hits 50, I'm out. And that's okay, and absolutely we should be managing risk like that. But a trader 2.0 version of you says, okay, this needs to go in 15 minutes. If this thing's still tossing about in 15 minutes time, I don't want it, because it's a momentum ignition trade. And if my thesis is momentum ignition, why am I still in it when it's chopping around? And so adding sometimes a time stop to the trade that says, right, this is momentum, it has to go. If I'm still messing around within 1 hour of my entry, I don't want it. because I'm not right. Now, the argument is like, well, you should hold the trade because it's regardless. Fine, if that's the way you want to operate, but I like to calibrate and feel like I'm surfing the conditions I've got in front of me. And if I think I'm trading momentum ignition and that thing just stalls, I'm probably wrong. So maybe I'm wrong on the entry as well. Why would I want to risk it? And so adding an extra layer of not decision making, a filter, if you like, to say, hey, I'm not going to sit with trades that aren't really doing what I'm doing. And now when you look at your own data, you can look at price stops and time stops. You might find something glaringly obvious. If you go back and look at your journal, you might say, you know what? These trades that don't do anything for ages, most of them lose. Like if I'm trading this breakout and it sits there and I'm sitting there flicking around my entry for ages, most of the time that doesn't go to target. So it does make sense for me to use a very strict time stop and say, if this doesn't go straight away, I'm out. And similarly, I don't know if I've got a slide for this, maybe I have, we'll skip it. But similarly, if you've got a price target, right, if you're looking for a range expansion, you might say, this is probably only going to run for an hour or a day if you're on the higher time frames. I'm overstaying my welcome, especially if that first sequence. Now, if you're looking for multiple sequences and back fully prepared to sit through pullbacks and all that's fine. But maybe you say, I'll hold this for an hour and I'll close it. So you can go, and sometimes some of my trades are like this, actually. I don't even look for a price. I don't got a target. I'm like, I'm holding this until X o'clock. I'm holding this till the bell. I'm holding this for 1 hour because I'm trying to calibrate to conditions. I believe I've got a low print, for example. I think based on previous price action and judging those previous rotations, I'm expecting a 45-minute rotation here. I'm going to hold this thing for 30 minutes. Timer goes on, dink, and I sit there and I've got my stop obviously to come out if I'm wrong, and I see where we're going in 30 minutes. 30 minutes is up, I reevaluate or I close the position. And I say, okay, yeah, that's the rotation I expected. But many traders go have I want 5R from this or 2R this price target. And very often we don't always hit those targets. We have maybe hit them before and they're valid resistance zones. Doesn't mean you're going to hit them again. And so sometimes adding this extra layer, and I don't want to add complexity to your trading, that's the last thing I want to do. But adding this extra layer in of, okay, there's a time parameter. This has got to do it in a short amount of time. Trader Peter Daniel, my good friend, he trades higher time frames. His time element is he starts to see a breakout on the higher time frames and the currency pairs. He does trade some of the indices as well. But when he's trading that specific setup, he wants to see it come back to the breakout level over a period of time. So he uses that reverse logic of, I don't want to see it come straight back. I don't want to see advertising higher price and sellers going me, and smashing that bid down over that day. He wants to see advertising higher price. He wants to see the buyers backing off slightly and a day of drift. So a minimum, I've got those fireworks again, a minimum period of time for it to come back before then the next leg up. And so you can use it as you want, but it's a real key element of a great trading strategy. So building a time-aware playbook. Document time factors for each setup. So thinking a little bit about, hey, how long your trades work for, right? How long should you be holding trades? What's that optimum level for each different strategy? The mean reversion, whether it's a momentum ignition, thinking about, anything that you can do to adjust and improve your trades. Do you need to have a restriction on how long before the trade goes in your favor? Should you be capping trades off or trimming them or managing them after a period of time? There's always little different permutations and ways you can adjust this. Which setups work best when? Which time blocks work best for your specific style and strategy? And just really going into that analysis and review process by saying, okay, here's my journal, here's my trades. I want to explore how time plays a factor in this, because very often we're looking at price, looking at maximum adverse excursion, maximum favorable excursion, looking at all this stuff, the P&Ls, but very rarely do we go, and sometimes we look at it and go, oh, that the best trades are held for a long period of time. Well, that's okay, but there's a chunk in the middle that probably can be improved by making some tweaks and adjustments there. Okay, so spotting algo timing. This is something that maybe you can go away and do yourself. Very often we have algorithms kicking in top of the hour, bottom of the hour. And if you're in tune with the conditions, you can wait for this algos to kick in and you can use them as leverage to initiate position. Again, it doesn't happen all the time. And at the moment, it's not much at all because we're just obviously running on headline tariffs. But we've had periods where they've come into play at certain hours, and if you're there and you're observing, you can say, you know what, I'm going to wait for certain filters and I'm going to initiate a trade. Let me show you an example. So a while ago, like at the beginning of the year, we had, or was it late last year? I can't remember the time we were doing this. We had this 6 o'clock algo that used to kick in all the time, 7 o'clock algo, and it was basically, if we're extended away from the VWAP, we'd have this wide range bar pushing back to the VWAP that was a kind of a buy program kick in, and you could trade from that. Now, I'm giving you just an example based on previous price action we've had, but the key for you, like I said, there's nothing glaring at me at the moment, which I'll definitely share with you if I saw it, by the way, is to always be looking when you're reviewing your trades, like, hey, is there something that kicks in at a specific time of day or near to a specific time of day that I could potentially use as, a trigger to get back in? And so the rules of this trade were, okay, between or after 6 o'clock, sometimes it'd be 6 o'clock on the dot, sometimes it'd be 7 o'clock. If I see this, if we were away from the VWAP and I see an ignition candle back in the direction of the VWAP, I'll take the trade. Now, again, this is just a rough strategy. I'm just sharing with you something that was effective then, doesn't work now. But the point is that you can find these times when often algos kick in and it's a resumption of the trend, it's a reversal of the trend. And that's why being in tune with your market and being very, very aware of these time segments is so important. Okay, final thing here before we take some Q&A, guys. Think of the rotations, right? I've talked about this before, but these rotations of the market and how long they take and the distance is very, very useful. There's a price and time square tool on TradingView that you can use. And very often, if you're measuring the duration between highs and lows, you can use that to frame the next day's trade or the rest of the day's trade. Not always, absolutely not. We've got trade like today, which is very, very wild. But very often, if you put the peaks on and you see the times, sometimes that helps you guide your trade. You say, whoa, wait a second. I might want to short this high, but if I look at history, I look at the prior day's trade, or I look at the the morning's trade, I can see the rotations were 45 minutes. Let's wait another 10 minutes. Let's just see where it goes, and then wait for a trigger around that time, or a price excursion of the rotations. It's been $50, or it's been 40 ticks, or whatever it is. I'll wait for that to come in before I start fading that. And that can help you find these time patterns. And then you layer in your existing technical stuff, your setups, your plays, your engulfing bars, your ignition bars, all the other juicy stuff that you like. You then layer it in with that time filter to really start to add some edge to your trading. And it just helps that timing so much. There's nothing perfect out there, but when you see it and you see it go, yeah, you know what, I'm going to wait. Now's about the time I want to see the reversal. You're there, you're ready. Reversal comes in, you're in, your stop is very, very clear. Time of day's right, you've got your target. It all just fits. It's a much more relaxing way to trade. Okay, if you've got any questions, ladies and gents, I will take them. Before I do that, I've got a couple of slides extra for you. But chuck them in the chat while we're there. So key takeaways, just while you're putting any questions in. Structure, as in setups, strategies, plus time equals edge. I think that's an absolute unbeatable combination. You've still got to have risk management, you've still got to have discipline, you've still got to understand price action, but adding that extra layer of time in is so important. Trading with the rhythm, not against it, understanding when we're having the range expansion, volatility expansion, backfilling, consolidations, testing of new highs, advertising for higher price. When do I expect price to advertise for higher prices and stick versus fail? Just simple questions like that. Using time-based filters is super easy thing to do. Very, very simple and helps you stay on the right side of stuff. Is it a perfect filter all the time? No, nothing is. It'd be great if it was. Right, I was just going to go long in this period. I'll put full net worth on leverage and Warren Buffett. Watch out. It doesn't work like that, sadly. But it can help us reduce the losing trades, can help us getting caught up in chop. And we need move the dial slightly to make a big impact on the quarter P&L. Okay, so action steps for you potentially. Analyze your performance across the day. Have a look, see if you do better during a certain time. Honestly, I've seen traders before and I've looked at their their blotters, and I've said, you just need to restrict the time, man. look, sometimes this is something, if you find this low hanging fruit, it's a really easy win for you. You might say, you know what, I shouldn't be trading the afternoon session. I just don't have it, or I shouldn't be trading anything during this period. And often it's a very simple filter like that can change the P&L structure in an instant. So defining maybe ideal windows, adding filters for that. Update your journal so you are kind of analyzing time a little bit more, not necessarily just logging time, but kind of segmenting stuff. I like to segment to AM, lunchtime, PM. That's very rough and simplistic, but that just works. And then also from your perspective of being the expert in the market that you trade, studying top of the hour, bottom of the hour. When do the big rotations come? You know, they come when algos kick in. Do they come algos kick in when we're super stretched? And then you're looking at like 6 o'clock shock that used to be so effective many months ago. We used to have what I called we had Noon Balloon. That was the Noon Balloon. We used to have Mr. 3 p.m. Mr. 3 p.m. used to come in. Everyone would be waiting for Mr. 3 p.m. He'd come in, bang, the market would go bid, and you'd be there. And then people would start front running it, and it disappeared. There's always something where people have to do volume, and they can hide it, and they're way better than they were, and they can segment up, piecemeal up things into smaller size, and start lifting offers, pulling back. And if you it's just going to stuff that is probably not interest you in the slightest, but a market nerd like me looks at all this stuff. If you look at some of the algorithm white papers and you see how they operate, obviously loads of them are super top secret, but if they're doing a basic, hey, we're going to split that order up in few, Mr. Institution, come and trade with us. You can see that sometimes they are aggressive and they take offers when they see the opportunity. They're opportunistic, and sometimes they have bids, but they have to still execute, right? And to execute, very often, if you are the aggressor and you are lifting price and you haven't got the opposing seller, you are going to move the market. So as much as they're much better at hiding their footprints, they still need to transact. For you to buy, you need to buy. I'm talking about if you're going direct to the exchange here, different if you're trading with a CFD or a spread bet and a different counterparty, but ultimately you're buying. An institution buys, he has to buy from somebody else who has to sell to them. And that might be multiple sellers at higher prices. So the point is they can't hide everything. They're very good at disguising, but they can't hide everything if they want to get some stuff done. And sometimes they don't care. Look at Friday. They don't care. They need to get out that door now. They couldn't care less what price they got. They just need to dump it and get down to a risk allocation size that they are happy with and comfortable with to hold overnight. So that's it for you guys. We rushed through loads of stuff. I love this topic because I think it's a big needle mover for many traders. As a little more advanced, I appreciate that. And if you're brand new to trading, you probably like this is relevant. And if you're brand new to trading, then stick with the technicals, stick with price action, and then maybe add into your calendar. Hey, do I want to study price? Do I want to study time? Do I want to look at maybe adding a filter of time into my trading? Okay, there's a few questions. I know the market is busy. I appreciate your time, ladies and gents. Thank you for coming on live. I know there's a lot going on. I know it's sun's out as well, and it's probably way down the list of priorities for you to go on a join me for a webinar when the market's volatile and the sun is shining. But so I appreciate you coming here. Okay, Mr. Valone has said, I've noticed same pre-news moves as well in Forex, almost like a tell more than not. Unsure why. My conspiratorial brain tells me big players have access to the data news earlier than the rest of us. Yeah, Mr. AV, that's perfectly possible. That there's a whisper of the news coming out. It could also be that people are, they really believe that it's going to be good and they convince themselves and they want to get a certain risk allocation on. And there's a lot of people who don't want that. And so you cause that kind of flush in one way. Often with stocks, actually, you get a bid up towards earnings that drifts off coming to earnings day because people are lightening the load. Earnings comes out in line, and the next day's a rally, and everyone's like, "Why is it rallying?" Well, it's those people who peeled off that because they thought it was high risk, because they looked at prior price action, and maybe there's a few earnings misses that caused the stock to absolutely get hammered, and so they took off the risk allocation and peeled it back on. We see that sometimes as well with some of the economic data. If the prior releases were a little bit of a shock, there's a little bit of nervousness coming in. So anyone position long might go, well, I'll peel off some risk and add it back on if we come back in line. So there's that. There's the rally up and there's all sorts of stuff, man. You've got to, and it's calibrating to what's happening at the moment in time. Sometimes it's that, sometimes it's the other. So it's good. Okay, Alex Salas says, how do you deal with the larger spreads we're seeing at the moment? If my DAX spread is 3 times the normal spread, reduce size and take the trade anyway. that everything adjusted to the new size, new spread, higher ATR. It feels like the spread may ping me in without a trigger if I'm using limit orders. Same problem with the exit. The wide spread will activate the TP order before the planned exit. Yeah, you know what, Alex? This is the name of the game. The spreads are liquidity's drying up. There's no volume on the order book. Spreads are going to be wide. I think when you look at spreads as a percentage of the ADR, that's how you calibrate. So you say, right, the ADR is just trebled, so the spread is trebled. So really, I'm in the same ballpark. You don't want to be in a situation, mate, where the 3-point spread is that crucial to you. If you maybe widen out the parameters of the trade, and yes, everyone would like a tighter spread. I get it, but the market conditions, fast markets are fast markets. Maybe say to yourself, hey, if it matters that much, 3 points, so you're trading the DAX, then maybe kind of dial down the size as you're doing and adjust the stops a little bit wider, positions a little bit wider, so that you're kind of accommodating that little extra bit of noise. I think like traders, we have to think like entrepreneurs, right? An entrepreneur is good at solving the problem in front of them, the resources they have, resources of experience, capital, mental focus, spreads, the brokers, all the stuff, the technology. And so this is where we are. This is the conditions we've got. And so thinking, okay, how can I make this not be detrimental to my trading? And I think that is probably saying, okay, I need to not make 3 points that important. It should be 30 points is important, not 3. Eduardo. Good to see same faces in here. Hi, Mark. About potential targets, I tend to rate my setups A, B, C based on several nuances, one of them being the potential target of it. What is your take on targets and affirmations like, I only take potential ones 2 to 1, 3 to 1? For me, it's difficult to let a good setup just because the potential RR. I'd rather size it as a C trade and put a smaller clip. What's your take on this? Okay, so I think what you're saying is you still want to take the trade if it's 1 to 1, but you want to take a smaller setup. Hey, do you know what? I think I might be misunderstanding the question here, Eduardo. So forgive me if I am, but I don't think the A, B, C should just be on the risk reward. Now, perfect scenario trade is I'm putting a high probability of success on the trade, and I've got a decent risk reward ratio. So 3 to 1, and I've got a 60%, 70% chance. That's brilliant. That's an A grade trade. If you've got 1 to 1 and you've got 80%, or your market 80%, we never know, that'd still be a grade A trade, right? And one of those could be a little flush off the lows. You're not looking for anything big off that. You're looking for a little pop done, but there's more than likely going to work because you've read it correctly. So I would maybe revisit that and say, hey, I don't grade it just on A, B, or C. I grade it based on the probability of success, because you wouldn't take that 1 to 1 trade or 1 to 2 trade if you didn't like it. You'd be like, I don't want to take it, and maybe that's the answer. Maybe you just don't take those and you just take the 3 to 1 trades. How are you feeling in terms of comfort? It's probably the question to ask yourself. Like, am I okay with taking the smaller trades? And just adjusting. There's no right or wrong. A lot of this is personality. Like, if you have to adjust and adapt to suit you, you've got some conflict there where you're saying, hey, I find it difficult to let a good setup go just because the risk order ratio isn't that good. But well, that's the thing. A good setup can still be a low risk order ratio, but if you think it's got a high probability, it's a great setup. If I said to you, Eduardo, pal, here's a 90% success rate trade, but actually you're only going to make half what you risk. The risk order is 0.5 to 1. You'd take it all day long. You'd be like, well, yeah, 1 out of 10's losing. Yeah, I might lose twice as much, but numbers work out. And so you can still, I know traditionally people say, oh, you should have good risk order ratio on it, which I think is a good starting point. But if you're in tune with the market and you're putting a high probability of success on the trade, the risk order ratio is perhaps less important. Okay, so Parkinson says, thank you, Mark. Super useful session. Glad you enjoyed it, Robert. Confirm some things I felt, specifically DAX is far easier to trade 8 to 11 a.m. British summertime when it tends to go mental after 2:30 p.m. So I may just ignore past 11:30 until 3:30. You know what, Robert? For focus perspective too, I think that's the right move. I'm always in favor of throttling down because we think we're you've got superpowers, right? I think I can focus forever. But I know if I've been focusing on tape, I've been watching price, making some trades, and I come back later in the day, I know I'm not the same trader. I know I'm more fatigued. So I'm very, very mindful of that. So less is more. So if you're saying, hey, I think I might just ignore that, I would just trade 8 to 11:30. That's your specialist zone. That's where you put all your focus, all your energy, all your effort, try to find some great trades. After that, you do research and stuff. Okay. Thank you, Robert. Good question. Okay, a couple more questions. How do volumes affect the shift in the market and how to really track it? Festo says, how do volumes affect the shift in the market? Generally speaking, larger range is larger volume, Festo. Not always, but generally speaking, you've got a big range, you've got big volume because lots of participants are playing. I'm not a big fan of just looking at volume and taking too much into it because, like I say, I think that larger volumes, larger moves. Look at that on a 1 minute chart, like a daily chart, it tends to be tends to go hand in hand. And you know, volume is, just remember, even on an up day, there has to be an equal number of buyers and sellers. There's not a mismatch. For a trade to take place, a buyer has to match with a seller. For the market to move higher, it just means the buyer is willing to pay a higher and higher price. On that sell-off we had on Friday afternoon, they were selling, someone was buying all that, but the seller was like, I want out now, went out now. They were more time sensitive than price sensitive, whereas the buyer was sticking at the bid saying, you come to me, pal. They're like, okay, you come to me, you come to me. And so it's the aggressor that tends to have more control over where price could go. Martinez says, thank you, appreciate that. Victor says, excellent, thank you, thank you, thank you, Gary, thank you, Sonia. Sonia's got a question actually. Sonai, sorry. Would you take the candle closing times into consideration, for example, retracements on the opening of candles, etc.? Oh, this is a can of worms you're opening here. Listen, I think that sometimes the candle can be a little bit misleading. The lower time frame you go, the more misleading it is. Just because the price happened to be at a low and happened to be at a high, that 1 minute move prints a big green candle. Really, you want to say the distance the price has moved. You know, so I think the important thing is a close. Daily close is super important because that's important for everybody. 1 minute, 5 minutes, it's not that important for most people. And so you can slow down the decision-making process by waiting for a close. I think that's a good thing from a discipline perspective. But just be a little bit careful about saying, oh, look, the price is closed there, so I'm adding more weight to that. I think that's a little bit of a trap because you think about logically, it's just a timestamp, 5 minutes, done, where price was 5 minutes. And it's almost luck that it happened to be at that high point and printing that big green candle there. You're far better looking at price, just pure price, and judging it yourself and saying, hey, the taper's run on hard from that low point to that point. And you know, if that's in the middle of two candles, it's going to be a mismatch of candles. You might have a bit of a green, you might have a second half green versus one long big green. I understand that we have to use it to a certain extent, but just be a little bit cautious on that. James says, thank you, James. Victor says, do you have any strategies where time does not seem to play a role, or should time be included into every strategy? Time should be included in every strategy, Victor, honestly. And I made that sound like just a sweeping statement, but even if it's, hey, what day of the week are we, and what, you know, where's the urgency? And yeah, I think even if you would take the trade regardless because of some other higher parameter, like now, right? The time is a little bit less important because more important is the headline news. If we see like a trap set and a retracement and headline coming in, I know we've had a bit of two-way trade, but theoretically, it doesn't matter what time of the trade, because the most important thing that everyone's watching is the headline. And so there are times when maybe it's not as important, but I definitely would, consider putting time into every trade you do, even if it's on a loose parameter. Sven says I was late. How can I get a copy of the recording? It's coming to you, Sven. Pepperstone should send it to you. If you don't, just reply. If you're on my daily email list, you can check out tradersmastermind.com, sign up for that. If you reply to that and just ask for a copy of the recording, and we'll send you a copy. Sandeep says, in relation to the trap times of 4:30 p.m. and 6 p.m., surely isn't this associated with when it's US lunchtime soon? 2, I usually see manipulation between those times, and generally indices tend to take off around 6:30 p.m. Yeah, absolutely, Sandeep. Lunchtime in the US, European close, so it's a obvious liquidity suck. A lot of volume coming in, people getting a little bit more urgent into the close. DAX, FTSE, Euro stocks, that shuts off, and we're starting to wind down for lunch. if you're an American hedge fund manager, are you going to wait until the European close? Probably are on a busy day. Like, right, that's done. Let's go off and do the meetings and stuff. So absolutely, it all ties in together. And you see, you've noticed manipulation between those times and generally take off around 6:30 p.m. Yeah, you know what? You're observing time and adding time into your decision-making process. That's absolutely right. And that rotates. Sometimes it's a little bit later, sometimes a little bit earlier, but it's being in tune with the conditions you've got in front of you. Thomas says, I'm an hour late, aren't I? Did you just log in, Thomas? Recording on its way, pal. James says, why have risk be reward and let trade run until it reverses and hits trailing stop? Why have risk and reward, let trade run until it reverses and hits trailing stop? One way of trading, definitely one way of trading, James. Absolutely. Trading stop can be a way of coming out. For some people, that gives back too much. If it's an A to B trade, then my argument is you don't want a trailing stop. You're trading from this level to this level, and this expansion, a trading stop ruins the efficacy of the trade. Now, if you're trying to catch a breakout and you don't know how far it's going to go, perfect, mate, perfect. Trading stop is exactly the right tool to use. I don't know how far this goes. We're expanding range, we're expanding volatility. I'm riding this sucker as long as it goes. I'm going to stick with the 10 period moving average and trail it above that, below that, whatever it might be. But if you're trading kind of this A to B type trade, there are times when I think the trailing stop is actually one of the worst things you can do. Personal though, man. Don't take it wisely with a pinch of salt. Sandeep says thank you for today. Mohammed says thank you for today. The session was very useful. Appreciate that. Thomas, thank you for all your content. Yeah, thank you, Thomas. Would you willing to be accept an email from a stranger? You know what, Thomas, if it's something, an interesting question, then absolutely. I reply on a serious note. I think I've replied to 99% of emails. If you send them, reply to the daily email, that's the easiest way to get to me. Put an FIO for me, Armand will send it over. Honestly, I do reply to 99%. Sometimes I don't reply to stuff because I'm like, you're asking something it can be freely available, but it's very rare I do that. So yeah, absolutely, Thomas, to answer your question. Thank you, guys. Robert says trail stop on a 10 period moving average on which time frame? Yeah, 1 minute, a 9 period or a 10 on a 1 minute. Watch how that hugs price, especially on the volatility breakouts. Stick it on your chart and have a look. Sometimes a really good way of kind of running with the flow, not being too tight, not being too wide, but kind of trailing that momentum. I think he's a 9 actually. 9 or 10, same thing. The difference is minimal. That's it. Thank you, guys. Great webinar as always. See you next week. I thought I'd added some stuff to tell you what's coming up next. I thought I did. There we go. Very, very quickly. Next week, we've got edge validation and self-coaching. But just help you be a bit more of a coach to yourself. Look at yourself from a risk manager perspective, as well as the trader perspective. And this is part of our Trader 2.0 webinar series. And we couldn't be more perfectly timed with the conditions. Anyway, stay safe, guys. Keep your risk managed. I'll see you next week. Bye-bye.